Hi, it's Mike Sinclair here from examreviews.ca. I just wanted to give you guys a quick tutorial on one of the topics covered in 2350 Financial Management at the University of Ottawa. So one of the last things you do in the course, or one of the last topics that you talk about, is the capital cost allowance and the tax shield. So I wanted to give you guys a quick example to kind of make this seem a little easier than it might look when you first started studying. So in this example, we're going to look at an asset that has a value of, or that has an initial price of $1,000. We're going to use a CCA rate of 20% and our tax rate's 50%. So let's take a quick look. We'll just do 2 years. I'll show you guys how this works. It's not as bad as it might seem. We'll start at the year one. At the beginning, the unused capital cost, which is the value of the asset today. We just bought it. So on our books and our accounting software, it's worth $1,000. To calculate the capital cost, what we're going to do is we're going to take that $1,000 and we're going to depreciate it by 20%. So we're going to multiply that by 0.2. Now, for those of you who may have forgot, there's a rule that called the 50% rule that we must apply to the first year when calculating the capital cost for an asset. So what we do is we multiply this by 0.5. So we're actually going to reduce the value of that asset by 50% less than we would in a normal year. So when we do that, we get our capital cost allowance for the year of 100. So basically what we're doing is we're going to, over the course of this year, we're going to reduce the value of that asset by $100. So at the end of the year, our new unused capital cost, we started with 1,000, we're going to subtract the 100, okay, the depreciation for the year, and we're left with 900. Now the tax shield, okay, so we've just basically incurred an expense of $100, but we didn't give anyone any money. So it's kind of a unique expense. So the tax shields represents a tax savings that we will get from that depreciation, from that expense that we didn't actually pay. So the way we're going to do this is we're going to take that CAA, capital cost, and we're going to multiply it by the tax rate. So in our case, the tax rate's 50%. And we get our value as, or our tax shield for the year, the tax shield value as $50. Okay, so this would be a cash flow. If you're looking at an NPV calculation, this is a cash flow in that first year. So let's do one more year. So if we go to the second year, we are now starting off this year. The asset is valued at $900, so the unused capital cost, the ending of the first year, or the first year becomes the beginning UCC for the second year. We'll then calculate the capital cost. Now this year, we do not need to apply the 50% rule. So what we're going to do is we're going to take our 900 and we will just multiply that by the 20%, the CCA rate. What we end up getting is $180. So it's unusual, but usually the CCA is more in the second year than it actually was in the first. Now every subsequent year, the third, the fourth, the fifth, is going to work exactly like the second year. So we know that at the beginning of the year, the asset was valued at $900. We are going to subtract the 180, and we now have a new unused capital cost of $720. The tax shield in the second year, we're going to take the 180, okay, so the CCA in that year, we're going to multiply that by 0.5, and we get $90. Okay, so the tax shield in the second year was a little bit higher, it was $90. So that's how the CCA tax shield is calculated. Again, we could do this for 3, 4, 5, 6 years. Okay, these represent a cash flow for the given year. So anyways, I just wanted to give you guys a quick example and simplify that. If you want to learn a little more, we're going to go through topics like these at the final review sessions for financial management. This is just one small topic. So make sure if you guys want to learn a little more and see, we'll do weighted average cost of capital, decision making, NPV, bonds, etc. Register at examreviews.ca, and I will see you guys at the final review.